Welcome to enrichminds.com and to our session on comparable company analysis. In this session, we shall study the second method to value companies. It is called the comparable company analysis. We shall also see how we use this method to value securities or shares. Comparable company analysis, or COMPS for short, is a valuation methodology that looks at ratios of similar public companies and uses them to derive the value of another business. COMPS is a relative form of valuation, unlike a discounted cash flow or DCF analysis, which is an intrinsic form of valuation. Let's look at a video first, courtesy of Corporate Finance Institute, and then we shall learn the technique step by step.
How to perform comparable company analysis. We're going to outline 6 steps of how an analyst goes about performing comparable company analysis. The first thing is to build a list of comparable companies that you're going to use to evaluate the one in question. You can research this on Bloomberg, Capital IQ, or from equity research reports, and narrow it down to a list of the top companies that you want to use. Once you have your list, you can go to Edgar or the company's website and download the financial information that you need. Then you're going to download 3 to 5 years of historical data. This means you need the company's annual reports and quarterly reports. You'll be using the income statement, balance sheet, cash flow statement, and the notes to the financial statements. You'll extract from those financials the revenue, gross profit, EBITDA, EBIT, net income, etc., and other important information like the number of shares outstanding, historical share prices, and other key information. Then, once you have the historical information, you're going to get forward-looking information. That means finding forecasts from equity research reports, or getting it from Bloomberg or Capital IQ, and the company's forward-looking guidance as well, if they provide it. You'll want the main income statement and cash flow items here for the forecast. Once you have all that information, you can build the table. So you can start by calculating the market capitalization and enterprise value. Then you can use the financial information to build the ratios, growth rates, and margins, etc. in the table. And then finally, you can compare and adjust the numbers, including normalizations or including and excluding other companies. And finally, arrive at what you believe is a reflective range of valuation for the company in question.
This is the first and probably the hardest or most subjective step in performing a ratio analysis of public companies. The very first thing an analyst should do is look up the company you are trying to value on Cap IQ or Bloomberg, so you can get a detailed description and industry classification of the business. The next step is to search either of these databases for companies that operate in the same industry and that have similar characteristics. The closer the match, the better. The comparable companies should be similar based on criteria that include industry classification, geography, size, such as revenue, assets, employees, growth rate, margins, and profitability. Once you've found the list of companies that you feel are most relevant to the company you are trying to value, it is time to gather their financial information. Once again, you'll probably be working with Bloomberg Terminal or Capital IQ or Yahoo Finance or any other financial services portal, and you can easily use either of them to import financial information directly into Excel. The information you need will vary widely by industry and the company's stage in the business life cycle. For mature businesses, you will look at metrics like EBITDA and EPS. But for earlier stage companies, you may look at gross profit or revenue. In Excel, you now need to create a table that lists all the relevant information about the companies you are going to analyze. The main information in comparable company analysis should include company name, share price, equity market capitalization, or equity market cap for short, net debt, which is the total debt minus cash on the balance sheet, enterprise value, or the EV, which is equal to the equity market capitalization plus the net debt, revenue, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and EPS, which is earnings per share. With a combination of historical financials and analyst estimates populated in the comps table, it is time to start calculating the various ratios that will be used to value the company in question. The main ratios included in a comparable company analysis are market cap to revenues, market cap to EBITDA, price to earnings, enterprise value to revenues, and enterprise value is commonly also called EV, enterprise value to EBITDA, enterprise value to net income. Analysts will typically take the average or median of the comparable company's multiples and then apply them to the revenue, gross profit, EBITDA, net income, or whatever metrics they have included in the comps table. In order to come up with a meaningful average, they often remove or exclude outliers and continually massage the numbers until they seem relevant and realistic. For example, if the average PE ratio of the group of comparable companies is 12.5 times, then the analyst will multiply the earnings of the company they are trying to value by 12.5 times to arrive at their equity value. Remember, market cap is the value of the shares only, but enterprise value is the value of the equity plus the debt minus the cash on the balance sheet. You have to make sure the ratios are consistent with the valuation outcome. This is what a comps table would look like. We have taken 5 companies here in the FMCG or fast-moving consumer goods sector. We have then tabulated their financial data and calculated their valuation ratios. And inside the red bordered table, the valuation ratios are calculated, and inside the black bordered box on the bottom right, you see the averages of the various ratios. So we can use these multiples to value any company that is similar to the 5 companies listed here. Let's now discuss our main takeaways from today's session. While DCF is an objective valuation method, comparables analysis is a subjective method since it depends on the comparables that are selected. There is user bias in this method. You could select such comparable companies to support your valuation targets, be it positively or negatively. And one should use various valuation techniques together and not in isolation. Thank you for your time, and until next time then, stay enriched and strong.